Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gcl Technology Holdings Limited annual report. Gcl Technology Holdings Limited offers a diverse range of businesses and services across various industries. At the core of their operations are the manufacturing and sales of polysilicon and wafer products for the solar industry. They also operate and manage solar farms in both the United States and China. In addition to these primary activities, Gcl Technology Holdings is involved in several other sectors. These include the manufacture and sale of ingot, trading of wafers, research and development of electronic special materials, and their sales. The company also engages in construction and sale of solar farm projects, providing equity investment, investment management, and asset management services. Furthermore, Gcl Technology Holdings offers business management, real estate development, and real estate consulting services to its clients. This comprehensive range of businesses and services positions the company as a multifaceted player in various markets, contributing to its growth and expansion. Gcl Technology Holdings Limited market capitalization of $28 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Gcl Technology Holdings Limited holds a significant advantage in their industry. Gcl Technology Holdings Limited trades at a higher price-to-book ratio of 0.56 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 44% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. On one hand, revenue growth is attributed to several factors. Firstly, an increase in sales of polysilicon by RMB 1.18 billion, 13.6%, contributed significantly to revenue growth. Additionally, compensation income and write-back of other payables also increased. Furthermore, improved granular polysilicon quality, increased client loyalty, continuous process optimization, technology upgrades, and higher product quality advantages recognized by the market and customers all played a role in driving revenue growth. On the other hand, revenue decline is primarily driven by several factors. Firstly, sales of wafers decreased by RMB 343,290, minus 10.2%, which had a negative impact on overall revenue. Secondly, government grants and bank interest income declined, further contributing to the revenue decline. Lastly, unbilled receivables decreased significantly from RMB 455,834 million in 2024 to RMB 202,032 million in 2025, indicating a decrease in revenue. In conclusion, while there are several factors that contributed to both revenue growth and decline, it is clear that sales of polysilicon and wafers, government grants, bank interest income, and unbilled receivables were the primary drivers of these changes. The net income of the company experienced a decline from 2024 to 2025, indicating a decrease in overall profitability. In contrast, the profit margins showed mixed results across different business segments. The solar material business saw an improvement in profit margins, rising from -16.9% to 9.4%. However, the solar farm business witnessed a significant decline in profit margins, dropping from 16.9% to -22.5%. The divergent trends in profit margins between these two business segments suggest that the company's operational efficiency and pricing strategies may have varied across different areas of its operations. The company's financial performance has shown a significant improvement in recent times. One of the key indicators of this growth is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its core operations than it spends, resulting in a net increase in its cash reserves. This achievement is a testament to the company's efficient management and effective implementation of its business strategies. The company's ability to manage its expenses and optimize its revenue streams has enabled it to generate a positive operating cash flow, which is essential for sustaining long-term growth and stability. The company's financial health has shown significant improvement in recent years. A notable trend is the substantial decrease in debt levels. According to the data, total indebtedness dropped by a considerable RMB 592 million, and net debt decreased by RMB 4,559 million. This reduction in debt is reflected in the company's balance sheet, where total indebtedness fell from RMB 19,096 million in 2024 to RMB 18,504 million in 2025. The decrease in debt levels has also led to a significant reduction in interest expenses. Interest expenses plummeted by RMB 169,683 from RMB 636,290 in the previous year to RMB 466,607 in the current year. This substantial decline is a direct result of the company's efforts to manage its debt and reduce its financial obligations. The decrease in both debt levels and interest expenses indicates that the company has made significant strides in improving its financial health and reducing its reliance on external financing. The financial performance of various segments and regions has been analyzed, revealing both positive and negative trends. In terms of poor performance, the solar material business and the solar farm business in the People's Republic of China, PRC, have struggled, with losses of RMB 2,085,374 and RMB 472,123 respectively. On a more encouraging note, the solar farm business segment has shown strong performance, generating significant revenue. This is particularly noteworthy when compared to the solar material segment, which has underperformed. The USA region within the solar farm business does not appear to have been negatively impacted by these trends. Management is optimistic about the company's outlook despite the challenges posed by industry restructuring. They see this period as an opportunity for growth, leveraging the dual advantages of technology and ecology to drive high-quality development. To achieve a successful turnaround, management emphasizes the importance of eliminating inefficient production capacity and achieving a balance between supply and demand. This strategic approach is expected to position the company for long-term success in the industry. There is no notable activity to report on acquisitions and divestitures. The company has not engaged in any significant transactions involving the purchase of other companies or assets, nor have they sold off any major divisions or subsidiaries. This suggests a stable and focused approach to business operations, with no major changes in ownership or structure. The company's financial activities have been notable in recent times. One key aspect is its decision regarding shareholder returns. On the one hand, the company has chosen not to pay dividends to its shareholders. This means that instead of distributing a portion of its profits as cash payments to investors, the company has opted for other uses of its funds. On the other hand, the company has engaged in share buybacks. This strategy involves using company funds to purchase back shares from existing shareholders, thereby reducing the total number of outstanding shares and potentially increasing earnings per share. By doing so, the company aims to boost investor value without distributing cash dividends. That concludes the financial summary for Gcl Technology Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.